Hi, I'm Peter Rose, founder of Longwood Currency Trading. 3 keys to managing your Forex trading success. Pretty cool stuff. And just 3 things that I think helped me really lock in on the 3 key concepts that I needed to be aware of all the time, even before I got thinking about structuring my trading rules or looking about entry analysis or position management or any of that stuff. This stuff is foundational, and I think you'll find it very informative. I'll list the 3 things up front, but just because you hear them doesn't necessarily mean you would understand their importance or their implementation, so I'd encourage you to stay through the video. My videos tend to be educational and not entertainment, so if you're looking for entertainment, here's the 3 things, and you can move on from there. Otherwise, I'll take each one of these and expand on it in a little bit more detail. So briefly, the 3 keys to managing your Forex trading success is: number 1, trade because you want to, not because you have to. Number 2, cut a negative, what I'll call a negative or a bad trade. Cut a bad trade fast. And number 3, have reasonable profit expectations. So I hope you can see how those things all sort of tie together to form the foundation of everything else from a rules standpoint or trading methodologies or anything else that you're going to be building upon. This is the thing that you build these things on. So we're going to take a look at each one individually. And thanks for hanging around. Okay, the first one: trade because you want to, not because you have to. We don't like doing things that we have to do. You have to go to work, but you might not necessarily like that. You have to get gas in your car, but you might not necessarily want to do that. I want to go to my kid's birthday party. I want to go to the latest release of the movie. I want to try and compare this Cabernet with one from another vineyard. I want to try the new hamburger that some restaurant has come out with. Those are the things that we enjoy, we look forward to, and we do good at, right? But the things that we have to do, we tend to do them to the least acceptable level because we'd rather be doing something else. I mean, if you'd rather be watching a movie than sitting there watching the squiggly line and trading, you're going to be distracted in what you're going to be doing. So it isn't so much just a simple thing as that. It deals with our emotional makeup as a human being. If your brain is a little Twitter jibber-jabber thing, you're not going to be able to trade because you just think you're going to go in there and, you know, buy and close out 4 pips higher at 500 to 1 and make $200 for the day on your $500 account or whatever it is. You have been lied to in almost all of the videos that you see out there. I have no reason to bullshit you. I'm 76 years old. I retired a millionaire from my 40 years of investment in real estate. I was a senior software engineer for 33 years, writing complex business applications and having a great time. I've been 58 years now in the martial arts, studying martial arts, karate, self-defense. So I'm not in a position where I need to bullshit anybody. And that's the reason probably I don't have a lot of subscribers or followers or people taking my courses or whatever, because I'm honest about things and people don't want to hear, for the general part, the honest views of how to trade. They want the secret sauce or whatever. You're still watching this because you're not one of those people. And so don't trade when you don't want to. You say, but Peter, how am I going to make any money? You make money by being consistently profitable when you do trade. And that gets into your win-to-loss ratio. How many times do you win is a function of how many times do you lose over, say, 100 sample size of trades, which really isn't enough. Because if you're a day trader, you're making a couple of trades a day, maybe 3. I mean, my fast track course is geared around building a foundation for you and showing you how you would create rules so that you could get all your trading done in an hour or 2 hours a day, and then you got to go off to work. Everybody works. I don't work. I'm retired, but I'm saying everybody else, is working. So if you're working a job and you have some money that you have available for investing, then that's the person that I'm talking to, not that 22-year-old who's spending as much money as they have coming in and having a Yahoo time and looking at maybe getting enough money so they can buy a Lambo. That's clouding the issue of whether you want to trade or you have to trade. You're sort of building a condition within yourself where you look at the currency market and you say, this is a really cool market. It has a lot of advantages. And I could go on for hours about that. But you're looking at the Forex market because you see those advantages. The question is, how do you take advantage of them? How do you implement them? How do you build rules? How do you, all that other stuff? You have to be interested in that so that you have a desire to look at the screen and make the determinations in a rational manner as to whether you can hit bid ask and get into a position. If you don't have that want, but instead you're saying, geez, I need to trade because I got to get off to work and I've only traded once so far this week and we're on Thursday already. Well, that's not the right attitude to have. What difference does it make? What you're trying to do is build the confidence that when you get in and you make a trade, you want to be anyway 60-40 win-loss. And maybe your skill will bring you up to 70-30. It's very hard to get higher win-to-loss ratio than that on a transaction basis. I'm about, when I'm following my rules, I'm about 73 winners on a transaction basis. On a daily basis, over whether I did one position or whether I did 3 or 4, I'm running about, I think it's 82% winning days. So there can be 2 or 3 losing transactions during the day, and then I make 1 or 2 large ones that make up for that, and that counts for a winning day. Or I might make $2.80, and it's still a winning day. But I won. I didn't lose. Because when we lose, we tend to feel bad about ourselves, and you don't want to trade then because you don't want to be a loser, right? So you have to develop good trading skills so that you want to trade. Don't ever trade because you have to. Okay, well, the next bullet point of the 3, we just got done talking about trade because you want to and not because you have to. And the second one is cut a bad trade fast. Well, that's how we always hear it presented to us. But I don't like to use the term bad, and I do in all my videos because people understand the term bad as opposed to what I would prefer to use as negative. So you cut a negative trade fast. It will be almost impossible for you to cut a bad trade because the connotation that we have on a bad trade is that we made a mistake, we were wrong. And because we don't want to be wrong and we feel that we have this omnipotent ability to judge that we should have been able to get into that trade, and we hit bid ask and we're in there on a long side, and if the trade starts to go against us, then we made a bad decision. And that reflects poorly on us, and we don't want to believe that. And I think that's one of the reasons why traders fail so much, is because they have too high of an expectation of their ability, and so when it goes badly against them, they don't want to admit that. And instead of taking a short loss and getting out, they go, oh, well, it'll bounce off the 20-period moving average. Oh, it can do that. It'll bounce off the 50. It'll come back. It's Tuesday, and I'll do a carry trade, and it'll be okay. And all of a sudden, you're 200 pips out, and you're fucked. All because you considered that you were bad. Not the trade, but you were bad. You have to change the way that you think. My karate master, Grandmaster S.A. Brock, put it this way. The only way we can change who we are into who we would like to become is to alter the way that we think, because we're a product of the way that we think, and thoughts are things. So if we think we're bad, we become bad. So instead of saying that you're going to cut a bad trade short, because you won't, but you will cut a negative trade short. Because a negative trade means that the price went against you. You had a good probability from your entry rules that that trade would continue on in the direction toward your profit target that you wanted it to, right? But it didn't. So it wasn't a bad trade. It just was price didn't go in the direction that you wanted it to. So it was a negative result to your probabilistic estimation. And it's because it's only an estimation, you got the estimation wrong, and so why not cut it? Okay, so you make 1 pip or you make 2 pips. You know, if you made 2 pips every day, 2 pips, 5 days a week, that's 10 pips, 40 pips a month. Let's call it 400 pips a year. You're trading a $10,000 account. Let's say you trade 1 full lot at $10 a pip. You make $4,000. Make 40% on your bank at 2 pips every day. Now that's a mathematical exuberation, but the only way that works is if you get out of those negative trades as fast as you can. It's very difficult to tell when you've made a mistake. You will know when you've made a mistake when you let that trade go against you too far, all the way to your stop. Let's say you're like everybody else out there. They set long stops at 20 pips because you got to give price room to breathe, right? Well, if you have 6 20-pip losses in a row, which as a day trader, 300 trades a year, statistically you're going to get 6 losses in a row. You're going to get 6 winners in a row too, but you don't count the winners because you feel you deserve those, right? But the 6 losses, they really hurt and they make you feel bad. And those 6 losses of 20 pips, that's a lot of pips. It's going to take you a long time to make that up. And so you start thinking about yourself as being a bad trader. And now you start forcing trades. You start doing anticipatory trades. It's a shit mess. When it's just simple, as Master Brock taught me, to alter the way that you think, because you're a product of the way that you think. Don't think of yourself as bad. Think of the market as simply not following through on your probabilistic estimation. Market doesn't give a shit what your probabilistic estimation is. That's just a guess. So it turns against you. And it's negative. You know, it went in your favor. It went down against you initially 3 or 4, 5 pips, and then it went back up and went back up a little bit more, and got up to about 8 pips, and now it's falling back down against you. It's not going the way that your condition in your entry rule, if you've done it through my fast track course, the way that entry rule stated that price action should behave according to the conditions of why you took that trade. And so if it's not behaving correctly, then the market is experiencing some kind of a chatter thing or whatever. Well, why stick around? You just get out. And it doesn't affect your ego at all. So don't think of your trades as being good or bad. You don't even want to think, oh, I made a good trade. I made a good decision. That's immaterial. Over 100 trades, what difference does it make if this one is good? From a percentage standpoint, if you have more good positions than you have bad positions, and when you have a good position, it makes you a little bit more money than when you lose, you're going to make a lot of money. So good and bad don't have anything to do with it. If you get into a trade and you have a position and it's not doing what you thought it was going to do, get out. Take 2 pips and you'll do fine. All right, let's move on to our third topic, which is have reasonable profit expectations. Remember, the first one was we trade because we want to, not because we have to. The second was we're going to cut negative trades fast. And the third one now is have reasonable profit expectations. And this is probably the most important one, because if you don't have reasonable profit expectations, then when the position goes against you, you're going to consider it bad because your expectation was too high, and you're going to hang on to that losing trade too long, and you're going to lose more than you should have to make up for whatever your win-to-loss ratio is, right? The reasonable profit expectation, I don't think that for the most part, you're going to be able to learn how to manage this, excuse me, on your own. When you're looking at trading, you're not trading to screw around. Or, I mean, you know, if you've got a $500 account and you're trading at 200 to 1, you're screwing around. And that's why my coursework and my consulting and stuff is geared for 30 to 50-year-old. That's my avatar or whatever ideal client, because you've been through life a little bit and you understand what reasonableness is. And so by having a little bit of direction from me in a structured course framework as we go through, the whole course is based around reasonable expectations. And the most important of those reasonable expectations of the trading process is your ultimate profit. Ultimate profit meaning how much do you want to make a year? You have to ask yourself when you begin your trading with the skills or whatever it is that you've got from whoever it is that you got those skills from, is what did those skills instill within you to the cost that you paid for your training, the amount of money that you have involved in it, the time that you're going to spend at it. How much money would you have to make at the end of the year to justify all of that work? You do the same thing when you go for a job interview, right? You know how difficult the job is going to be, and you say, in order to put that much work and time in and listen to all this bullshit from some boss screaming at me, you know, hit your numbers or hit the door, you expect to be paid X number of dollars a year. And if the guy says, you know, your expectation is $60,000 and you've backed that up before that you're worth $60,000, and the guy comes back and offers you 53, you go, you know, I'm sorry, that's just not, you must not need somebody with my skills, because my skills are worth this. And you know that your skills are worth that, and they're reasonable. And so when you look at your trading, what do you hope to get out of that? Again, I don't work with hobby traders. I work with folks that ultimately want to replace their job income. Now, whether they'll be able to replace their job income or not, that's the goal. But if you could make 40% of your income through your trading, or even 20% of your income through your trading, make it $60,000 a year. You know, if you could make $12,000 from your trading, that'd be enormous, right? If you could make $6,000 against a $60,000 income, that's a 10% raise. Wouldn't you expect to get a $6,000 raise every year at your job? No, that isn't a good expectation, right? You're lucky to get 2% or 3%. So if you were able to get a 10% profit a year from your trading, that would be great. Or a 20% profit, or whatever percentage against your bank you're capable of getting to generate $20,000. It's not real hard to make $20,000 if you have a reasonably sized bank. I mean, you know, come on. If you're going to play and screw around in the stock market and you want to trade more than a few times a week, you're called a pattern day trader, and you have to have at least $25,000 in your account to trade. So all these guys that are running around in the currency market trading with $300 and $500, $1,000, $2,000 accounts, you're kidding yourselves. You got to be prepared to invest some money if you want to get a car. I just went out and bought a small mid-sized truck because my car died, and well, I'll get a truck. Well, my expectation was a little bit low. I hadn't bought a vehicle in a long time, and my expectation is I'd be able to get something old and beat up that I could just take the dog for walks and the dump runs and throw a kayak in the back. That's all I want to use it for. I don't want to pay $40,000 for a truck. Well, my expectation was a little bit low, so I had to bring that up to match the product that was available with my needs. So I didn't spend $40,000. I spent a lot less than that. But I got a good truck, and so I had reasonable expectations after I learned what the market was about and what I was capable of paying, right? So when you look at your personal situation, your age, your income, your disposable income, your goals, and your expenditures, you look at that and you say, if I could get 10% of my income, that would be great. That's reasonable relative to the size of the bank that you have. Well, you might not want to go into this thing after you learn your skills and stuff with more than $30,000. You're not going to do that unless you have full confidence in your ability. Well, that's what the Fast Track program does. You send me an email. I'll be happy to chat with you about Fast Track. Not that I'm trying to sell you a course. I don't have anything to sell, but I'd like to talk with you to explain this stuff to you in a little bit more detail, so that if you haven't got into the trading yet, or you're involved in it but in a small way, but you like it and you see the potential of it, but you just don't know how to take advantage of that, I'd be happy to chat with you about that, either through email or maybe we'll get together on a video conference or something, and we'll chat about that. But the main part of the chat is, well, where are you at right now, and where do you want to be in 20 years? And if you were to get involved in trading, what would be considered a success for you? And then I can say, well, okay, in order to get there, as a beginner, you might only get X% against your bank as a return. And so that would probably work if you could get that size of a bank. Do you think you could get that size of a bank so that you could make that return? Because after you learn these things and you get experienced at what you're doing, then the percentage returns against your bank increase. I mean, there's people that, they're at the far end of the curve that could make a couple 100% a year against their bank, or a couple 100% in a few months if you're trading at high leverage. I don't teach high leverage. I want to be realistic about things. I want to instill proper risk management. That's the foundation of this whole thing. Do you realize that all three of these things, these three keys to managing your Forex trading, are all risk management concepts, right? And the most important one is this third one, is having reasonable profit expectations so that you don't consider yourself a bad trader when you push the envelope too far and you bust out. So that you set reasonable profit expectations so that you can achieve them and feel good about your trading, so that you have confidence that the rules work. And then, I don't know how other people teach or whatever, but toward the end of that Fast Track course, a 6-week program, will mention when certain opportunities come along, then you swing for the fence. You try to swing for the fence. Now, there's some people that shouldn't swing for the fence. There's certain things that you shouldn't do when you swing for the fence. But when you know how, and more importantly, when you should swing for the fence, you push all the chips to the center of the table and let her rip. And that's, if you look at any of the really large, successful traders, they'll say that probably 80% of their profits at the end of the year come from maybe 2 months of trading, 3 months of trading, a small portion. But you don't know what 3 months those are. But you have to be ready for them. So if 80% of the profits come from that, then the 20% of profits would be, if you didn't hit any of those spectacular profits, then your expectation is, well, if I'm going to have this 20%, I'd be happy with that. It would be worth the effort. I just didn't hit one of those times where it was time to swing for the fence. So having reasonable profit expectations gives you sort of an excuse not to do stupid shit. Because as soon as you do one stupid thing, it will be compounded by another one, because you will consider it a bad thing that you made, a bad decision that you made, and you'll then be having to take the trade to make the money up. And so all three of these keys to managing your Forex trading success go to shit. And 90% of the traders lose 90% of their money in 90 days. So you don't want to be in the position where you build your account up to $100,000 and you do stupid shit and lose the $100,000. I've done stupid shit and lost 6 figures. So I know all about having reasonable expectations. And if you'd like to talk to me about that, send me an email. I'd love to chat with you. Again, email. If we do a video conference, I promise there's no pressure on my part to get you to buy a course from me. It's just me. There's a course manual, but it's my time. I'm working with you, taking my time to do that. So because I'm doing that and I don't have a team, I don't have any assistants or anything, I'm retired. I don't want to fill my days teaching currency trading. That's just my personal choice. But I want to work with a few serious people. So I'm not trying to sell courses. I'm trying to help people so that they don't have to take a course from me. I don't know, you believe it or not, doesn't make any difference, because nobody's going to call me anyway, and that's okay, because I just sip my coffee and enjoy we're in what we call now almost into stick season. I think you can see out there, it's a early November day in 2025. The leaves are just about all fallen from the trees, and we're going from fall into what they call up here in the Lakes region of New Hampshire, stick season. And that's all you see is sticks. But I love it. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.